Good morning, ladies and gentlemen. This is Tony from Financial Juice for Macro Race, going through the US consumer spending report with you and what to expect for the release. Hopefully, you can all hear me okay, and hopefully, you can also see the screen. So let's get into it. So first of all, what is consumer spending? Well, it shows how much US consumers are spending on goods and services. So in the total dollar amount, and also shows the percentage as well. And the key thing to remember is the difference between CPI and the PCE price index. And this is also going to be quite key for today's economic release that we get, is that CPI measures a fixed basket of goods over 2 years, whereas the PCE price index measures can chop and change what it measures. And the PCE price index is the key gauge that the Federal Reserve uses to for their own inflation expectations for in the coming months, and also for future expectations as well. So the reason why the Fed uses the PC price index is because the PC price index can, as I said, chop and change. So if we have an example where chicken prices in the CPI price index is used, maybe chicken prices are quite high, and then but in the PC price index, if let's say for instance if beef is what everyone is buying instead, then the PC price index would measure that instead of chicken prices. So that's one thing just to remember, is the difference between CPI and PCE. Price index is CPI, it measures the fixed basket of goods, whereas the PC price index can kind of chop and change as to what's actually going on within the economy at that within that month. Also, the PC price index includes prices in rural areas as well as those paid by organizations that have spent on behalf of households. So you've got to think about healthcare or any other company benefits that those businesses provide as well to consumers, and that's also included within the report as well. So that's also just something to bear in mind. Then, how does it affect the markets? So in a normal environment, when there's a healthy increase in personal incomes and also spending, that usually bodes well for the US dollar. If you have higher consumer demand, that encourages more growth and puts upward pressure on interest rates. So what that would mean is, if consumer spending is really, really strong, then the central bank could step in to try and dampen consumer spending by raising interest rates and making things more expensive if businesses have to pay more for the goods that they create from borrowing money. And in turn, those high prices would lead to consumers paying more for those goods. So that's what happens. That's what happens in a normal environment, when there isn't a tightening phase or where there isn't an easing phase. But that's something that can lead to. Also for stocks, so higher personal income and spending is also viewed favorably in the stock market, because that also, as said, fuels economic activity and increases corporate profits. Of course, if consumers are in a spending mood, even in a risk-off environment where markets are scared or fearing that the central bank will raise rates further, or they're in a hiking mood, then even then we can still see a healthy pickup in stocks, particularly stock indexes. And we'll go through why we had seen a positive reaction from the S&P 500 last time round. So bonds then. So any data that affirms sluggishness within the economy, and it is expected to support higher bond prices and lower yields. So if usually in a normal environment, when stocks are doing well and those assets start to see an increase in the valuations and consumers are in a healthy spending mood, usually people would only jump into bonds if the economy if there's a potential recession that might come around, or maybe the economy starts to falter. So only then, if you do get negative consumer spending data, that you could see a pickup in bond prices and you'd see lower yields. So that's what happens within a normal environment, just to make you aware of that there. So that's how it usually affects the markets. Now, so the previous report in April, and this is quite key, of course, of how the S&P 500 and stock indexes and stocks in general could react, and the reason as to why it reacted in a positive way the last time round. So the key thing is that consumer expenditure in the US increased by the greatest in 3 months in April, showing that consumers were coping with continued price pressures by delving into their savings. So you can see that. So usually within consumer spending, you want to see that consumers are actually not saving their money or putting it away for a rainy day, actually using their savings on luxury goods and other goods and services as well. So that's what you want to see, and that's what we saw in the April report, that consumers were actually taking money from their savings to spend on goods and services. Also bearing in mind, there are other points to think about as well, that with mortgages or maybe paying off some debt as well. So, of course, some consumers may use their own savings to pay off some debt that they have. But that's the key thing, is that consumer spending had increased by the greatest in 3 months, and they were able to deal with the price pressures. So purchases of goods and services grew 0.7% from March, and the finding supports estimates for consumer spending to continue continue a healthy trend in the second quarter, as consumers are supported by solid employment growth and accumulated savings. And the month's decrease in inflation was partly due to a drop in fuel costs. So overall, that stronger consumer spending helped the S&P 500 see a move towards the upside. And also, we've got to remember is that they had the PC price index that didn't really wasn't really out of the water. It didn't really blow itself out of the water. It wasn't a massive change or big deviation from the forecast. And you did see that some of the readings actually came in line with expectation. And then compared to the prior month, you also had a reading that was much lower than the previous figure itself. So combined with strong consumer spending, and we had more or less a weak PC price index report as well that coincided with that data, that has supported the S&P 500. Now, other points to consider as well is, where is the economy at the moment? Also, just to bear in mind, if you're watching this and you find it useful, don't forget to share this video and with your friends, your other fellow traders as well. If you feel that this information is useful and it'll be useful for them, then by all means, please share the video and show us your support as well, and that'll be lovely. So where is the economy at the moment then? So inflation at a fresh 40-year high at 8.6% versus a prior of 8.3%. The PC price index beforehand was at is currently at 6.3% versus a prior of 6.6%. Core PC price index year on year at 4.9% versus a prior of 5.2%. Non-farm payrolls at 390k versus 428k. Retail sales month on month showed a negative reading of minus 0.3% versus 0.9% prior. Consumer credit was slightly down in the prior month at $38 billion versus $52 billion. The unemployment rate was unchanged at 3.6%. And Q1 second estimate GDP showed the data. We had seen it come in at minus 1.5%. And if we were looking at yesterday as well, so the final reading that we had from the US, that came in at minus 1.6% for the final reading for the first quarter of 2022. So it was slightly worse than the second estimate, but again showed a negative reading for the first quarter of the US economy. The key point being here as well is for inflation expectations from the University of Michigan. That's, of course, inflation is the big dog topic at the moment for the markets, and the big focus as to how far the central bank or the FMC or the Federal Reserve will go to dampen the inflationary pressures. So you had the inflation expectation for 1 year tick down to 5.3%. from a prior 5.4%. The 5-year also ticked down to 3.1% versus a prior of 3.3%. So these readings here, or these economic indicators, are key to, first of all, one, showing where inflation is if we're looking at what the Fed's preferred method of inflation is to make future forecasts. And second of all, how strong is consumer spending overall within the economy? Are there being more jobs added, and is there a pickup in the labor force, or are there more workers that are taking those that are taking those jobs in order to, of course, if you have a job, that will also bode well for consumer spending because you'll have money to spend on luxury goods and services, rather than holding out with the claim from the government instead of getting money from the government. And then retail sales, of course, are people going to stores and buying those, again, luxury goods or getting luxury services. Again, that's quite key. So it's like negative. And, are consumers taking out more credit in the economy? Although, yes, it's still above zero, was slightly weaker than before. Okay, and of course, inflation expectations in the University of Michigan survey itself is also quite important to see how consumers are feeling, right? So that's quite key as well. Hey, Scotch and Stocks. Tony says, Tony, good day. Hope you are having a profitable day. Thank you very much. Hope you are too. And so if we keep going on then, so we'll go through the triggers then for the economic release of the data that we have coming up. So for consumer spending, so according to economists, they see a high estimate of 1.1% with a low of minus 0.1%. So for the consumer spending, they're actually looking for a 0.7 deviation on the headline figure for consumer spending month on month. And then, of course, about a 0.5 deviation the other way. Personal income high, the high estimate they see a 0.8% with a low of 0.1%. So if we're looking at personal income, so they're expecting a 0.3 deviation on the forecast, or a 0.4 deviation for the low end. PC price index month on month, again, as I said, key measure for the Federal Reserve. So the PC price index month on month, they're expecting a 0.8% high and a low of 0.5%. PC price index year on year with a high of 6.6% and a low of 6.2%. Core PC price index, high estimate of 0.6% with a low of 0.3%. And core PC price index year on year with a high of 4.9% with a low of 4.6%. So the key thing is, they're not, for the PC price index, if we're looking at the year on year, they're expecting a 0.2 deviation with a high estimate compared to the forecast, and a 0.2 deviation for the low end as well. So I think in general, we'd expect to look for overall the PC price index data. Then we'd look for we'd look for at least a 0.2 deviation and 0.3 deviation to get anything above 0.2 deviation. We'd expect a stronger reaction from the markets. Spending high with the consumer spending, or the headline figure that is touted. I think it is rightly so that we're looking for about 0.7 deviation, or at least a 0.5 for a deviation for either way, for the high estimate and low estimate, to get a strong reaction. Now, the views in JP Morgan, so their strategists estimate that the Fed interest rates and balance sheet policies will exacerbate what is already a sharp supply and demand imbalance in the money markets, which is around $1.5 trillion. So, of course, with the Federal Reserve and their potential removal of assets from their balance sheet, they're looking for, first of all, of course, the PC price index to tick higher in order to take quicker action to reduce that balance sheet. But if it does tick lower with the PC price index, again, they would look for, I think what the Federal Reserve would do is that they will kind of wait for the CPI figure for the next reading that we get next month to see how, if that does continue to tick higher, then they may need to do further or stronger rate increases. So, we could get another 75 basis point hike in July, which is what some money markets were expecting before we got the last rate decision. They also added that in the second half of 2022 that the evolution of Fed's monetary policy will continue to bring in both relief and continued challenges for short-term markets, according to strategist Theresa Ho from JP Morgan. Then BMO making it clear that having a consistent salary is important and that still tight job market provides that support, as according to Jennifer Lee, senior economist at BMO. But she did add that, however, high inflation is eating away at what one can buy. Therefore, the saving rate was brought down for the fourth month in a row. So what she's saying there is that, okay, consumers are spending more money, but they're actually delving into their pockets, delving into their savings, which to a degree is good that they want to, spend more money, but actually you want to see people not delve into their savings too much, because at some point that's going to deplete, and then what are consumers left with? They're only left with their salary. And if inflation is already at a fresh 40-year high and wage growth doesn't support that, or it doesn't match inflation where it is at the moment, consumers will have to pay more money for the goods and services that they need. And that may mean that the luxury goods that they would have bought during normal spending sprees, maybe during Christmas or in the summer or before the summer, that could actually drop off and not bode well for consumer spending overall. So then the Fed views what we have. So we had June 24th, we had Fed's daily that when markets price in an increase of 75 basis points, let's get that increase in. So a very hawkish comment from Fed's daily, who's usually more towards the center when it comes to whether being a hawk or a dove sentiment-wise. So this point being made that if the markets are expecting very aggressive monetary policy action from the Federal Reserve, we should match that, which that's the first time I've ever heard anyone from the Federal Reserve say that they should kind of go ahead, kind of follow what the markets are pricing in. But I think the key thing is that, again, it's to do with inflation expectations. If the markets are expecting high inflation figures and they're expecting the Federal Reserve to step in an aggressive way to curtail that or dampen those inflation expectations, then they more or less kind of need to meet market expectations. Otherwise, you'd see a very awkward reaction from the market. Instead, we could see the dollar weaken in the short term, and the S&P 500 or stock indexes see a bit of a boost or see some appreciation instead if market expectations aren't met. Fed's Bullard said the market has fully priced in of getting the rates or the interest rates or the Fed funds rate to 3.5% by the end of this year, and also saying households are in a great position to spend going forward. So again, the Federal Reserve seeing that consumer spending will be fine and they'll be able to weather the storm of these aggressive rate hikes that are happening within the economy. Remember, when the rate hike does happen, it doesn't immediately take an effect to the economy, right? Although borrowing rates, yes, that are increased, that takes time for that increase or that rate to have an impact in the economy. Usually, that takes about 6 to 18 months for that rate hike to take effect, or to actually see the effects of that rate increase. So he's seeing, or Fed's Bullard is the most hawkish from the Federal Reserve, and he's expecting that to consumer spending to be resilient. Then the current sentiment. So again, central bank tightening is the key thing. Again, focus is on inflation, and then there's the worry that with these extreme rate hikes from the Federal Reserve and also other central banks, that there could be a recession. And we know that with the S&P 500, what I use as the main gauge of how and what other economists use as how well the economy is doing, or are we seeing a potential recession? That, if I bring it on a chart for you, has if I go back higher, put it into perspective. This is always good to put things in perspective here. Here we go. So that's where, of course, we peaked at around 4,814, and we're, we're down by, we're continually heading downwards here. So on the day, we're down by 1.45% at around 3,765, whereas the dollar, or the Dixie, is up at the moment. So if we look at the Dixie up on the day by 0.29%. And if we're looking at other areas too, if we look at gold also slightly down by about 0.7%. So central bank tightening is something that's has been, something that's a constant worry for the markets, and that's been shown with the way that the markets have been pricing further rate increases in the future. Also, China's COVID easing as well. Also, looking at the other areas as well, so China COVID easing, that's helped to support that did help support the S&P 500 and also WTI crude oil prices too. Of course, that's also being played, and that's also had a play on sentiment as well. So inflation, of course, Powell, Lagarde, and Bailey yesterday they mentioned that inflation is going to be longer lasting. And also the University of Michigan inflation expectations hit its highest since June 2008. So also markets then, what we had today. So we know that bank stocks fell in pre-market trading Thursday, joining a larger drop in risk assets as investors fretted about a future recession. This morning, the S&P 500 futures were also lower, falling as much as 1.6%, while the US 10-year yield hovered at around 3%. But still, the 10-year yield is up by 160 basis points since the start of the year. So this expectation of Fed hiking, and of course with bond yields, is important to note that the markets are pricing in these rate hikes, and they know that short-term rates are going higher. And those longer term yields as well are also seeing an appreciation from the expectation of a rate hike. Right, so let's look at the previous market reaction then. So if I bring that up on here, if we go forward, 10 seconds. So this was the release here. So what you'll see is that the S&P 500 actually ticked up. Of course, with stronger consumer spending, that's what helped and also the more or less in line with expectation data from the PC price index. That's what helped the S&P 500 tick up. But also for the dollar, that did see some movement towards the upside. The main reason being is that consumer spending was also stronger than expected for the month as well. But you did see some of the inflation readings slightly higher than expected at 6.3% as well. So there's more of the data being more or less in line with expectation, but as seeing that you didn't see a negative figure from the inflation readings or the PC price index, we still did see some positive moves on the dollar. But the key thing for the S&P 500 is that the consumer spending was still strong after of course, we had our first couple of rates hikes from the Federal Reserve. Okay, so if I keep moving forward, and we've got about 3 minutes left. Okay, if I just skip that. Right. Okay, so let's get to our deviations then. So deviations then for the prior release. We'd seen that the S&P 500 on the first candle ticked up at around 39, has seen about 39 ticks towards the upside. And what we can see is that also with the NASDAQ 100, or the NASDAQ, we'd seen about 145 ticks towards the upside, and after about 10 minutes, it was up about 290 ticks. And then if we also look at the currency pair too, so the dollar yen was up 14 pips, and after about 10 minutes, it was up about 16 pips. And then with the bond prices, so the biggest mover currency wise, we'd seen it was the dollar yen. If we're looking at the other areas too, so with the US 2-year yield, the bond or 2-year bond price, we'd seen about 6 ticks down, about 10 ticks down after about 10 minutes of trading. So let's get the charts ready then on here. Okay. We also want our bonds as well. So if we get a 2-year bond ready. Right. Okay, let's get the FJ site in view. There we go. There's the data there. So markets. Okay, so 231. Looking for the other bit of data. Waiting for the PC price index data. Okay, so personal income was lower. Was excuse me, in line with expectation at 0.3%. Consumer spending was also lower at 0.2%, and the PC price index data was also lower as well. So 6.3% for the year on year compared to the forecast of 6.4%. So this is where we're seeing the S&P 500 see a move towards the upside with lower inflation readings. Just keep that there. Okay. Dollar yen. Let's see. Okay. So dollar yen seeing some movement towards the downside there. All right. So, okay. So the key thing then is off the back of this data is that because we got lower than expected PC price index data, that's what's causing the S&P 500 to tick up. And there wasn't anything to support the dollar. So overall negative PC price index data did see some weakening on the dollar yen. On the 2-year bond, so we can see that the price did see some movement towards the upside there. Again, off the back. So in turn, what you would see is that the yield would see a move towards the downside instead. S&P 500 down. Let's see if what was the other biggest reactor? Okay. Right. Okay, that's okay. So not really too much reaction there. Well, to be honest, on the euro dollar, did see that positive tick towards the upside. Okay. Also look at the other currencies too. Not too much move on GBP USD or cable. But compared to the other currencies, did see a slightly bigger reaction or bigger mover on the dollar yen from that data. Let's have a look. So there we go on the website there. So it's seen dollar index seeing a move towards the downside. S&P 500 seeing that appreciation there. But again, overall data was negative, and we'd seen some weakness in the dollar and some strength in the S&P 500. So if you're currently watching the tick strike, if you're watching tick strike here at the moment, of course, what tick strike does, if you're not sure of it already, what it does is it measures order flow within the markets, and it shows you that via a visual and audible alert. So of course, a visual aid here, and then the audible alert, which I've kind of turned off at the moment. But you also get that too, which makes a tick sound or whatever sound you want. But usually, if you pretend you're in the trading pits in the Chicago Stock Exchange, or back in the 80s, you heard all the guys and gals shouting, buy, 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 sell, sell, sell. Somebody, about to punch the other guy or woman because they got a better price, or, they bought against them. Bought against them to try and bring the other person down. That audio or that craziness that you usually hear and see in the market, in the trading pits, is translated on in the markets and translated into tick strike here. So it allows you to listen and look at the momentum that's going on within an asset class or different instruments that we have. So of course, with what you can do is that you can also set the level of sensitivity. So one is the most sensitive. So any little moves here and there, as we can kind of see with the S&P 500, that you can see if there's a little bit of buying, then tick strike will go off. But if you want to only see when there's a big amount of momentum or movement that is occurring, whichever way, buying or selling, then you can decrease the sensitivity and put the number up to 15. 15 is the least sensitive. So when you put it 15, only when the trigger is matched and it meets the level 15, that's when it shows that when there is a lot more momentum within the asset or instrument that you're looking at. And that can be in currencies, in stocks, the futures, ETFs, ETNs, also crypto as well. So if we bring up tick strike here, so of course you've got a multitude of different options. So there we go. Forex, you've got a load of cryptos as well. Loads. There we are. Got all your cryptos there. Futures as well, stocks. We got a plethora of a load of stocks which we're continually adding to, ETFs and ETNs, and your internals as well. So if you would like a 7-day free trial of tick strike, then what I'll do is I'll put it here in the chat for you. Scotch and Stock says, thank you very much. Thank you. So that there is a 7-day free trial of tick strike that you can have a look at and have a little play with, and a trial of, and see how it goes for you. But a lot of what traders do, of course, if you're a scalper or you like to trade, if you want to kind of manage your risk, so that's a couple of the ways you can kind of use tick strike. Is some people use it to either manage their risk or to capitalize on potential trades if there's a lot of momentum in the market or a certain asset or instrument. But again, that's just some of the ways that customers have talked to us about of using tick strike. Of course, use it in your own way. I'm not telling you how to use it. But of course, that's one of the ways, a couple of the ways that people have used tick strike itself. Now, of course, the Financial Juice website, if you're familiar with Financial Juice, but if you're not, we're a real-time live voice and text service, or a real-time squawk service that we provide. So this level of detail is something that investment banks have, right? This level of access. Okay, just saying that OPEC endorsed its plan to increase oil production by 648,000 barrels per day in August. So no change from the prior, and more or less as expected. But this sort of like news that we see, that you've just seen now, of course, with the economic release as well. And that data that people have, that the investment banks have access to, they use that to manage their trades, but also, on the other hand, to capitalize on potential trades as well. So that's one thing to consider, is that with the live voice and text feed, that you can also do the same as well. Of course, use it however you want to use it, but those are the two key ways to manage the risk, and also potentially capitalize on potential trades as well. So we want to provide a 7-day free trial of that there as well for you. So I'll put that link in the chat. That is there for you. 7-day free trial. There we go. Financial Juice Pro. Now remember, with the Pro version, you don't get any adverts playing. You have no delay to the text or voice. You also get real-time data as well being populated in the feed here on the left-hand side. And also, of course, you have the opportunity to ask the news desk for any comments or anything you want them to search up. If you want them to search up about something, maybe it's a headline, or maybe where the markets are at the moment, maybe why the S&P is moving in a certain direction, and then that is available there for you to be able to do that and ask away questions. So there you go. You can use the news desk and talk to the guys there. Okay, but also as well with the economic triggers that you can set for economic releases. So if you were looking for the PCE price index data as your main, let's say, trigger to either buy or sell, then you can say, you could probably put a let's say sell alert if the actual, let's say we was to train the S&P 500 as an example. If you're putting a buy alert, a buy alert if the actual was greater than, let's say, 6.5%, and sell alert when the actual is less than you put a sell alert if you're trading the S&P 500, and if you put a buy alert if the actual, let's say, is less than 6.3%. Just as an example, you save that, and when the data comes out, that trigger will set off in real time. So when the data comes out, you'll see a lot of buy or sell signal here, if of course it meets your own trigger. Now remember, of course, I just did this as an example. You can set the figure to whatever you want it to be, depending on whatever asset you're trading or assets. You can do whatever you want with it. So ignore these figures here. That's just the forecast for the economic release. That's not us telling you what to do or where to put the forecast in. Again, this is something that you manually put in yourself. So again, there's another way and that's also real time as well and not delayed. So that's Financial Juice Pro. Also, if you liked this content and you've enjoyed this video so far and you've found it helpful, then don't forget to follow us on Twitter as well. That's the link there for our Twitter page, and also for our mailing list as well. So that's, if you wanted to, of course, look at the deviations, how the markets reacted previously, and also get an in-depth deal. Let me move Tick Strike out of the way. Close that. If you want to get in-depth details to how much the S&P 500 moved, or the currencies moved after a certain release, we've got a load of different releases that we cover. Some of them we don't do anymore, like the PPI one, because it doesn't see that much of a reaction from the markets. But we, a lot of the releases here, what I do as a Sunday is I put together like a little workbook or document of the releases that we'll be covering, and that's shown here as well. As you can see, we've got I've created a week ahead of what to expect for the different sessions, Asia, Europe, and the US, and the summary of the weekend news. And that is sent every Sunday during the day or before the Asia session begins, so you can kind of prepare yourself for the week ahead. There you go. That will show you when the times of the next releases, or the releases that we'll be covering, are, and when the room will start. So that is Financial Juice. That's Financial Juice site that you saw. Free trial you have there, 7-day free trial. Tick Strike as well. Also, we're bringing out a new product too. We have a new product out, or revamp of one of our other products called Unusual Activity. That is there with a beta test, which is free at the moment. So if you like trading unusual volume activity, or seeing unusual volume activity in stocks, and potentially trading on that, and then join the free beta test group of the new service of Unusual Activity, and have a little play with that too. So that's, as said, free. There isn't a trial for it. That's free for now. Alrighty, ladies and gentlemen, thank you very much for joining me for Macro Ace. I will see you tomorrow. Now, key thing is, for tomorrow, I'll be doing another live stream, but I'll be discussing how to trade economic releases as a whole, right? So, of course, there are different environments, there are different things that, impact the markets. And when some economic releases come out, they can have a different reaction at different stages of the business cycle. So I want to provide information and knowledge to you guys as to what to expect from economic releases, like what I've done now with the consumer spending report, but in a lot more detail. The last one I did was it took me, I think I did 2 hours worth of knowledge about risk on and risk off. So yeah, it was jam packed. So expect the same tomorrow too. It's gonna be jam packed with a load of data that we'll look at and analyze, and comments as well, and research that I've done for you guys. All right. Albert Mo says, thank you for your service. Real Idiot gives me a thumbs up. Scotch and Stock says, see you tomorrow. Yes, I'll see you tomorrow indeed. All right. That is of course, that's a video link for tomorrow. That you can join us live and watch that. So that's at 2 p.m. Eastern time that I'll be doing that webinar, that live stream on YouTube here. Again, no need to sign up. All you got to do is just click on the link on the Financial Juice website here, which will be on see here, there. You can click on that link and it will take you to the video or the live stream. Or what I'll also be doing is I'll post the video here in the feed about an hour before the stream is due to start. So you can click that there. But on the left hand side of the economic calendar, you can click it here and it'll open up to the live stream for you. Real Idiot says, spread the word. This channel deserves more subs. Hell yeah, baby. I believe it does. I know it does. But hey, that's down to you guys. If you can spread the word, if you like this video, by all means, please do. All right, ladies and gentlemen, thank you very much. And I will catch you tomorrow for how to trade economic releases. All right, bye now.